The Subcommittee on TARP Financial Services and Bailouts of Public and Private Programs will come to order. Today's hearing, we're going to hear from the Chairman of the Securities and Exchange Commission. And as we know from all the headlines in the newspapers today, this is the largest news in the world. But in all seriousness, we are very grateful for Chairman Schapiro's presence here today. She has always been forthcoming and forthright. And as is the tradition of the Oversight and Government Reform Committee, we're going to read the mission statement of this committee so we can keep that in mind for today's proceedings. The Oversight Committee mission statement: we exist to secure two fundamental principles. First, Americans have the right to know that the money Washington takes from them is well spent. And second, Americans deserve an efficient, effective government that works for them. Our duty on the Oversight and Government Reform Committee is to protect these rights. Our solemn responsibility is to hold government accountable to taxpayers, because taxpayers have a right to know what they get from their government. We'll work tirelessly in partnership with citizen watchdogs to deliver the facts to the American people and bring genuine reform to the Federal bureaucracy. I'll now recognize myself for 5 minutes for the purposes of an opening statement. Approximately 3 years into an economic recovery, America's labor and capital markets continue to face unprecedented challenges. The U.S. unemployment rate has now been above 8% for 40 consecutive months, and nearly 24 million Americans are either unemployed or underemployed. Since the beginning of the 112th Congress, the Oversight Committee has remained committed to identifying and modernizing outdated securities regulations that limit job growth and access to capital, which, as we know, is the lifeblood of our economy. Today's hearing advances our efforts as we welcome the Securities and Exchange Commission Chairman, Mary Schapiro, to address these major Commission reforms urged by this committee, such as the SEC's new policy on cost-benefit analysis, which we welcome, and implementation of the Jobs Act, which we want to remain vigorously committed to exercising oversight so we know what is happening with Commission proceedings. As I said at the opening, I certainly appreciate Chairman Schapiro's willingness to engage in this oversight, and as well as being forthright on her views on all this. We know it's a commission with 5 members, and so, but the chairman obviously has significant sway. During the subcommittee hearing in April of this year, Chairman Schapiro committed to the policies and principles of a staff guidance document in the use of cost-benefit analysis in the Commission's rulemaking. As I said, we welcome that. I think that's a significant step, and we certainly appreciate that. Chairman Schapiro's dedication to vigorous cost-benefit analysis, particularly after former SEC Inspector General David Kotz issued a critical report on cost-benefit analysis procedures at the Commission, as well as a number of other lawsuits. We appreciate the fact that the Commission acted swiftly and that Chairman Schapiro went even further and published this document and made it public to market participants and those that care about what the SEC does. And we want to talk about that today, and we want to give you an opportunity to explain where things stand with the cost-benefit analysis memo and how that's moving forward. But also, we want to make sure that the American people know what is happening with the SEC's actions when it comes to the Jobs Act. Portions of which were built around the efforts of this subcommittee and a letter from Chairman Issa to Chairman Schapiro in March of last year. That was a very positive exchange and the type of reforms American people can be proud of. In particular, Title III of the Jobs Act I have a personal interest in, as well as millions of small businesses around the country. And it's based off of legislation I sponsored here in the House, which is in essence crowdfunding. And it creates a new federal securities exemption to permit equity-based crowdfunding. After I introduced the crowdfunding bill in the financials in the House, we went through the Financial Services Committee. My colleague on this subcommittee, Carolyn Maloney, who also serves on the Financial Services Committee, raised a number of concerns in our first hearing. We tried to work together to craft an addition to deal with this fraud question. and to put in place what we thought was finely crafted legislative language that would protect against fraudsters, and at the same time give the SEC the power to make those rules and do it in a cost-effective way. It was a bipartisan bill. I was very proud to work with Carolyn Maloney on that legislation, and I think based on that collaboration, that's a big reason why we were able to get over 400 votes for this bill coming out of the House. I think that's also why the President endorsed this idea, not just in his job speech, but in the legislation we crafted in the House. Well, but unfortunately, I think a few senators, with some final changes that they made to the Jobs Act, were misinformed and misunderstood the opportunity that crowdfunding allows for and the nature of crowdfunding. And as such, there was an 11th hour change to the Jobs Act in Title III of the Jobs Act that deals with crowdfunding that causes some concerns. We had a hearing earlier this week, and I'm sure Chairman Schapiro, you and your staff saw some of the what came out of that hearing, and there were concerns about the legislative language, but there was broad consensus that the SEC can create rules and do so in a cost-effective way to allow crowdfunding to take place, so that small issuances don't have the heavy regulatory burden that the large issuances in our markets bear. Now, the large issuances certainly have a greater capacity to bear those costs than the smaller issuances. That's just economic reality. So I will have a number of questions about this crowdfunding piece of the Jobs Act, and I'm very concerned about that implementation and making sure that it's done in a cost-effective way so that small issuances can actually occur and do so in a way that is economically feasible. I certainly appreciate your willingness to be here. I thank you for your public service very sincerely. You've had a very long career in public service and have done so in a very honorable way, and I certainly appreciate that. And with that, I'll recognize Mr. Quigley, the ranking member.
Thank you, Mr. Chairman. Despite its importance, good morning, I do predict we'll have a ratings dip in about 15 minutes. I also want to thank Chairman Schapiro, who has been a regular witness at this committee and has been exceptionally generous with her time. It's a great benefit to the committee to hear your testimony, and we especially appreciate it during this very busy time at the SEC. As you know, Congress passed two major reforms of security laws and regulations over the last 2 years. 2010, Congress passed, and the President signed into law the Dodd-Frank Wall Street Reform and Consumer Protection Act. And, of course, earlier this year, Congress passed and the President signed the Jobs Act. And I, again, appreciate the Chairman of this committee's role in that legislation, the subcommittee. But the acts are two sides of the same coin and will both be important to job creation and our economic recovery. The SEC has significant responsibilities under each act to promulgate new rules. This process is necessarily careful and deliberate. Congress has made it clear that rules should be evaluated according to their cost and their benefits. With regard to the Jobs Act in particular, I hope the SEC carefully considers how best to protect investors while achieving our goals in passing that law. Going forward, I am confident in Chairman Schapiro and the SEC, even as they deal with short timelines. However, I think it is important that Congress keep in mind the SEC's substantial responsibilities when considering its budget and resources. So I want to thank the Chairman and thank our witness for her testimony.
It is the policy of the Oversight and Government Reform Committee to swear in all witnesses. Chairman is risen. Do you solemnly swear or affirm that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth? Thank you. Let the record reflect that Chairman Schapiro answered in the affirmative. We'll now recognize the Chairman of the Securities and Exchange Commission, Mary Schapiro.
Thank you, Chairman McHenry, Ranking Member Quigley. I appreciate the opportunity to testify regarding our implementation of the Jobs Act, as well as economic analysis and SEC rulemaking. In the 2 months since my last testimony on these issues, we've continued to work hard to implement the new statutory provisions and to ensure that our rulemaking fully incorporates appropriate and rigorous economic analysis. As you know, the Jobs Act makes significant changes to the federal securities laws. It changes the IPO process for emerging growth companies, requires the Commission to modify the ban on general solicitation and advertising, directs the Commission to implement exemptions for crowdfunding offerings and unregistered public offerings of up to $50 million, and increases the number of holders of record that trigger public reporting. The Jobs Act also requires that the Commission conduct several studies and prepare reports for Congress. The Commission's commitment to the successful implementation of the Jobs Act is evident from our actions to date. Where provisions of the law were effective upon enactment, we have already provided information and guidance to the public to assure those provisions are put in place in an orderly and effective manner. For example, on the day of enactment, we posted on the Commission's website procedures for submitting draft registration statements for confidential review, and that very day we received the first confidential registration statement from an emerging growth company using those procedures. We set up email boxes on the SEC website through which the public can submit comments on Jobs Act provisions before we even issue any proposed rules. Already, we've received substantial constructive feedback from a wide range of interested parties. And soon after enactment, the staff prepared and posted on the Commission's website several sets of frequently asked questions about matters ranging from the law's IPO on-ramp to its new registration and deregistration requirements. The extensive information the staff has made available is easily and clearly accessible on the SEC's website, and feedback from companies and their advisors has been extremely positive. Where provisions of the law required rulemaking, we formed intra-agency rule-writing teams which are meeting with interested parties, considering public comments, and preparing recommendations for the Commission. As I've mentioned previously, some of the rulemakings have unrealistically short deadlines. For example, the 90-day deadline for revising Rule 506 and Rule 144A to allow for general solicitation, with the statutory requirement for reasonable steps to verify accredited investor status for Rule 506 offerings, simply does not provide time for drafting a new rule with a rigorous economic analysis, considering public input, and reviewing a proposed final rule at the Commission level. We have, however, made significant progress on a recommendation and economic analysis and hope that the Commission will be in a position to act in the near future. With respect to the crowdfunding provisions, the staff is already crafting the many rules required by the Act, has published frequently asked questions, and is evaluating the more than 80 public comments already received. We are doing our best to meet the ambitious Jobs Act deadline of 270 days to complete the required rulemaking. As I mentioned in earlier testimony, economic analysis is an integral part of all rulemakings, including Jobs Act rulemaking. The staff guidance from March is being followed for both rule recommendations already in process and those at the earliest stages of development. Since the guidance was implemented, the Commission has approved 3 final rules. Each of these rules included economic analyses consistent with the guidance. In addition to implementing the guidance, we're strengthening our rule-writing teams by hiring additional economists. In the near future, 16 Ph.D. economists will be joining the Commission to assist in rule writing, and we've requested an additional 20 economist positions as part of our 2013 budget request. And of course, this supplements the already 23 economists we have who are devoted exclusively to rule writing. Our ability, of course, to fill future positions will depend on the resources provided by Congress. In conclusion, we're making significant progress in implementing the Jobs Act and are providing significant guidance to the public to ensure its provisions are workable and comprehensible. Further, the economic analysis guidance is informing our rulemaking and will continue to do so going forward. And I would, of course, be pleased to answer any questions you have.
Thank you, Chairman Schapiro. Thank you for your testimony. Members may have 7 days to submit opening statements for the record. So I'll now recognize myself for 5 minutes. In your written statement, Chairman Schapiro, you said something very encouraging. On the same day the President signed the Jobs Act into law, the staff received a confidentially submitted registration statement from an emerging growth company that used the new procedures the staff had posted earlier. It's fast action, right? That's positive. So, I mean, by its nature, you have entrepreneurs that are waiting. They want to act. They want to use this. You outline in your opening statement that one of the things you've done on crowdfunding is to inform market participants that is not yet available. The rules have not yet been crafted. So clearly, entrepreneurs want to participate, want to be active. So to that end, there's another provision within the Jobs Act, which is the lifting of the general solicitation ban. Will you meet as you outline in your statement, you believe that the July 4th deadline will not be met. Is that correct?
That's correct, Mr. Chairman.
When do you foresee this happening?
I expect that in the next 2 days we will actually publicly publish the timeline for the Commission consideration of lifting the general solicitation ban, and I expect that it will be done this summer. I think it's important to note that if it were as simple as just eliminating the general solicitation ban, and I read the transcript from the prior hearing, so I understand that there was some discussion about this, that would be a relatively straightforward thing to do. But of course, the statute actually requires that we require issuers to take steps, reasonable steps to verify that purchasers of the securities are in fact accredited investors, using whatever means the Commission determines appropriate. And taking steps to verify means there are probably lots of alternatives for doing that. Under our cost-benefit analysis guidance, we have to actually look at the different alternatives and weigh the costs and benefits of different alternatives for verification of accredited investor status. So we want to create something that's workable and usable. That is absolutely our goal. But it's a bit more challenging in rulemaking than it might seem on the surface because of that extra statutory requirement. But that said, the staff is significantly along in both the economic analysis and the rule drafting, and will come before the Commission this summer.
Okay. Well, in context of this, entrepreneurs are waiting, and we'd urge you to move forward with that. Now, there's also a deadline of December 31st for the Section 3 of the Jobs Act, which is the crowdfunding portion. Do you foresee meeting this deadline?
I don't foresee not meeting the deadline. The staff's working very hard on it. There are lots of rules, as you know. I know that you weren't happy about all of the rules that were added, the requirements. But we are working already on the issuer disclosure requirements, which are fairly straightforward, but also the intermediary and funding portal requirements of the statutory provision. So I think it's challenging, but I don't have a reason to tell you at this point that we won't make that deadline.
When will you issue a timeline for this rulemaking?
We haven't formally issued a timeline. We don't normally formally issue specific timelines. We did under Dodd-Frank give general ranges of 3-month periods during which we hope to get certain rules across the finish line or proposed. Because this one has a pretty short time frame, we need to get proposals to the Commission in the next several months so we can have a comment period and then take it to final. I will say we've benefited enormously in this one in particular from the advanced comment period that we had. I believe we've gotten close to 80, if I'm remembering the correct rule, comment letters about how we ought to implement these rules. We've had multiple meetings with funding portals, with associations that represent the crowdfunding industry, and with individuals. And so that's really helping to short-circuit some of the process in the sense that we're building up a base of knowledge very quickly at the SEC for handling this. So
due to the potential costs associated with the layers of lawyers and accountants and the financial intermediaries and on and on and on crowdfunding, we had testimony earlier this week that one expert believes that because of that layering on of the Senate provisions inserted on crowdfunding, that if the rules are not implemented correctly at the SEC, that crowdfunding could be, quote, stillborn. It's a pretty strong statement, but after conducting a rigorous cost-benefit analysis on crowdfunding rules under the Jobs Act, if you believe that these costs would render impracticable some or all of the uses of crowdfunding, basically price out small issuances, will you commit to telling this committee immediately that is the case?
I absolutely would, but our goal is to create a workable exemption. This exemption exists under statute. Our approach is going to be to follow the language of the statute, but to create exemptions that actually can make crowdfunding work. And my personal belief is that the requirement to use an intermediary can be enormously helpful here, because it can routinize a lot of the things that people might be concerned that they need to have lawyers to do for them or accountants to do for them. And so I think it will be both an investor confidence issue to use an intermediary, will give people some confidence that there's a regulated entity in this process somewhere, but I think it will also make it much easier for entrepreneurs to navigate the exemption and its requirements. So we'll be very sensitive to these issues about cost, and I will, of course, come back to Congress if we think there are things that are statutorily required that make it unworkable. But I am optimistic that we can write the rules that satisfy both the needs of small businesses to be able to use this effectively and efficiently, but also have basic investor protections in place.
Even small issuances?
Yes, even small issuances.
Okay. Thank you. I will now recognize Mr. Quigley.
Thank you, Mr. Chairman. Well, to the other side of that coin, Ms. Schapiro, I supported the Jobs Act and the crowdfunding provisions in it, but all the questions I asked are still what we're concerned about today, because many of the investors in crowdfunding are going to be comparatively unsophisticated, and there is information asymmetry or disparity there. You know, how do you take that into consideration on the SEC side? Because they are perhaps particularly vulnerable for the lack of sophistication or expertise, practice in investing in this sort of project.
Congressman, I think it's a very fair question, and I would say that the version of the bill as passed did build in a number of investor protections, including disclosure requirements for intermediaries, for issuers, the use of intermediaries who are subject to oversight of the SEC or a self-regulatory organization. But also there are requirements for intermediaries to take measures to reduce the risks of fraud in these transactions, and so those requirements will obviously be built out in the rules. But they include background checks, for example, on people who are associated with the issuer. And then I can tell you that we will monitor very closely how the exemptions are used, and if problems arise, we will address those very quickly. It is our goal, obviously, to protect investors, and I think everybody clearly shares the goal of having this be a useful exemption. And if it is fraught with fraud, it won't be useful for anybody. And so we understand that balance. We will work very hard to get it right. But I do think the statutory provisions build in some basic investor protections that will be very helpful.
Thank you. You've often asked about cost-benefit analysis. It's hard to put everything it's hard to quantify everything and put everything we might need into the issue of investor confidence. But earlier this week, we had a hearing on this matter, and Professor John Coffey of Columbia University Law School testified. He said, the greatest enemy of job creation today is not overregulation, but the loss of investor confidence. In particular, American investors have lost confidence in the initial public offerings process and the integrity of the mechanisms for capital raising. I want to get his quote right. As this process went on, I think it was March 13th, you wrote a letter to the Senate Banking Committee Chairman Tim Johnson, the ranking member, Senator Shelby. You said something similar. We must balance our responsibility to facilitate capital formation with our obligation to protect investors in our markets. I am concerned that we lack a clear understanding of the impact that the legislation's exemptions would have on investor protection. If your concerns and the point that Professor Coffey made are as accurate as they seem, how does the SEC take into consideration in this cost-benefit analysis, how do you put a dollar figure on lost investor confidence?
It's notoriously hard to quantify the benefits of any regulation. How do you quantify the benefits of preventing a fraud? How do you quantify the benefits of somebody who is burned?
Because it's not just the dollars they lost, which some people...
No, it's their unwillingness to ever engage with the markets again.
And people we don't, that are out there just not putting their dollars in.
Exactly. It's a concern about the integrity of the marketplace, whether they're placed at a competitive disadvantage vis-a-vis institutions, whether they're getting accurate and honest information from issuers, whether the market structure itself is tilted against the individual investor and in favor of the institutional investor. And those are all things we worry about all the time, because at the end of the day, investor confidence is the oxygen that the markets survive on. And if we lose it, it is extraordinarily hard to have it to regain it. And if you look at one very specific example I like to use, after the flash crash of May 6th, when the markets plummeted very quickly and companies traded from $40 a share to 2 cents a share, we saw net outflows from equity mutual funds every single week for about 8 or 9 months, because people just said, this is not a marketplace for me. I don't have confidence in its integrity. That was a market structure issue, not an information disclosure issue. But nonetheless, we know market confidence matters enormously, and investor confidence. It's hard to quantify, and the GAO in a recent study recognized how difficult it is to quantify the benefits of investor confidence. Where we can't quantify it, we will talk about it qualitatively, and we will talk about why it matters, and we'll talk about the larger economic crisis and what that's done to investor confidence, and use that as part of our analysis.
Thank you, and I yield back.
I recognize myself for a second round of questions. My colleague referenced your letter of March 13th to Chairman Tim Johnson and the ranking member of the Senate Banking, Housing, and Urban Affairs Committee, Richard Shelby. You outline a number of concerns you have with the legislation, the Jobs Act that we passed. And in particular, you have a number of concerns with the legislation that I wrote that was inserted into the Jobs Act on crowdfunding. Was this letter in response to a letter sent to you?
No, Mr. Chairman, it was not.
So it was unsolicited?
It was unsolicited. These were my views that I thought were important for me personally to express to the Senate Banking Committee.
Do you have my address? And I only say this in a joking fashion because I've seen you a number of times. You've been before this committee a number of times. I appreciate you being forthright with me. And as the chairman of the Securities and Exchange Commission, or if you were just a citizen, I would respond to your letter. I would read your letter. In fact, I read your letter at the time, and had you raised these objections to me, or I don't want to speak for my colleague from New York, Carolyn Maloney, but we would have addressed these provisions in the bill that we passed out of the House with over 400 votes. I think the President would have liked to have heard that before he issued a statement of administrative policy on my crowdfunding bill. And then finally, this is right before the Senate takes this issue up, and you outline these concerns. Chairman Schapiro, I would welcome your input to my legislation in an effort for me to fix it. And I would welcome your engagement in this process. But when I see this, I view that as being sideswiped by a regulatory body at the 11th hour. And this caused me great concerns. And I don't think that was the most responsible thing for action for you to take. The more responsible thing I would encourage you to do is to communicate so we could fix it coming out of the House and address these concerns. I amended half of my bill, over half of my bill, because of a concern that a colleague of mine across the aisle had. If the chairman of the Securities and Exchange Committee came to me with concerns about legislation I was writing that the Securities and Exchange Commission was going to write rules based upon, I would absolutely take that into account. And so I just want to express to you my deep regret that you didn't address this earlier, or to me. And to send an unsolicited letter to the Senate at 11th hour is I don't think, the best way to go. If you're responding to some letter, I think that would maybe be more valid, but in the future, I would like you to address that, especially if I have anything to do with the legislation. I would certainly welcome it.
Well, Mr. Chairman, I appreciate that, and I will absolutely make sure that with future bills that I talk to you or to the sponsors of those bills in advance. I did testify about some concerns we had with respect to a number of provisions. I don't know whether they were directly incorporated in legislation at the time, but with respect to the capital raising process and the small business capital raising process in particular. But I hear your point.
Thank you. Now, earlier this week, Mr. Cartwright testified before the subcommittee, and he said, quote, "After all, the SEC had sufficient authority to do almost everything the Jobs Act did without any legislation at all. Unfortunately, the Jobs Act was necessary precisely because the SEC did not believe in the need for what the Jobs Act seeks to accomplish." The reason why I say this in context with your letter earlier is you've testified since the Jobs Act became law that you would abide by the law. But your letter to Tim Johnson and Richard Shelby exhibits that you didn't like the law as it was written. So do you believe that the SEC had the authority to make these changes that are within the Jobs Act?
Mr. Chairman, my letter raised some specific issues and concerns I had that I thought should be addressed in final legislation that I believe were important for investor protection and, frankly, important for successful capital raising so that we could avoid the potential for fraud or misconduct. But I have also, as you rightly point out, said many times that it is the law of the land. We will implement it faithfully. And I think every action we've taken to date demonstrates exactly that. The positive feedback we're getting from the small business community, from our Small Business Advisory Committee, and even some of the witnesses last week, Mr. Cartwright in particular, who made the point of saying the SEC seems to be doing this with fervor and with, those weren't his words, but with real commitment. So I think everything we're doing demonstrates our fidelity to the statute and to accomplishing the goals of the statute. I would have to go through, I think there are some things the SEC could have done on its own, certainly could have even done when Mr. Cartwright was general counsel of the SEC. But I couldn't tell you off the top of my head whether every single thing that's in the Jobs Act could have been done without a legislative change. We'd be happy to do that analysis and provide it for the record.
I'm more interested in you doing the rulemaking that is currently obligated to.
I am too. I'd like to make this work.
So again, to this crowdfunding piece. Now, the structure of crowdfunding is different in many respects. We've got great experience with charitable crowdfunding, gift-based crowdfunding. The nature of somebody investing $20 in the local coffee shop that they go to every day, they want to own a piece of it, is structurally and motivationally different than somebody investing $10,000 in the Facebook IPO. Do you agree with that?
Oh, absolutely.
So sort of the lower dollar issuances are structurally very different. The motivation is different by the investors. Is that something that you would foresee the SEC incorporating, that structural difference?
Well, I think certainly there will be many structural differences between offerings done through a crowdfunding exemption and a full-blown public offering that's done like Facebook or another large company. So we'll see that play out in disclosure requirements with respect to sales practices, in all sorts of ways, there will be many structural differences.
The regulatory, the regulation of portals as opposed to broker-dealers, you'll take that into account as well.
The statute accounts for funding portals to be, a funding portal could be a broker-dealer, and we know of broker-dealers who are interested in doing this, but we also know of entities that are doing funding for charitable and other endeavors, as you point out, that are also interested in expanding into being crowdfunding portals under the Jobs Act, and we would expect them to be regulated differently. There are some limitations on their business, but the statute's quite clear that they should be regulated differently.
Okay, and so the SEC will take that into account?
We absolutely will, and we will obviously also put all of this out for comment, but and the portals have been in to see us, a number of them already, to talk about the things that they think are actually important to include, because I think they believe that they can perform a real service here and support entrepreneurs who want to utilize the crowdfunding exemption to do it successfully. And it is in their I don't think that was for crowdfunding. And they want repeat business, so they want it to be successful, and we hear that from them over and over again, that they want this to work.
And to that end, we heard from one portal who's represented by a gentleman named David Halil-Tuck, who testified that, quote, every securities market and or offering has a potential for fraud, but crowdfunding structures help minimize that risk. Crowdfunding is highly transparent, and there is substantial feedback from other community participants, the crowd. The crowd helps police players and keep them honest. Portals provide a clear and central location for communication by potential investors to analyze and share their views on offerings. The web-based structure also allows portals and regulators to provide risk disclosure and investor education. In addition, we expect portal operators to undertake a gatekeeping role in authenticating issuer identity and requiring minimum standards for issuers. And this is before rules have even been written. He outlines this. So do you agree that inherently the structure of crowdfunding, because of the structure of crowdfunding, there are significant protections against fraud?
Well, I think in a sense it depends. I think those are important protections. Many of those are actually captured in the statute, and I think they're very important. But I think we can also have a situation where a portal isn't policing the issuer and isn't ensuring that proceeds aren't transmitted before they should be and isn't ensuring that there's disclosure. And that's why the rules actually matter, that we capture those very ideas that are also in the statute in the rulemaking regime so that all portals are subject to it, because frankly, as you know, one that decides that the rules don't apply to them and anything goes and allows fraud to happen will hurt every single honest one that's out there. And that's why the regulatory regime matters. And we can't just assume that because people have approached crowdfunding responsibly in the charitable context, that when this business is opened up and there's the opportunity to solicit many millions of investors, that everyone will still continue to play by those high ethical standards. And that's what the regulatory regime is there to do.
I would say with billions of dollars already operating in this environment, with minimal fraud, that it shows that light touch regulation, transparency, basic rules of the road would be sufficient, can be sufficient to that end of mitigating fraud. To a different provision, and we had the minority recommended a witness, John Coffey of Columbia University Law School, and I had a few questions for him. Incidentally, he offered this, and I thought it was very interesting. So the innocent and material exemption, and is that it's Rule 508 in Reg D. So it's done for accredited investors currently, if I'm to understand correctly. So this innocent and material exemption could be applied to crowdfunding issuances. Do you foresee that?
I can't.
And would you support that?
I can't predict what the Commission will do, but
would you support it?
The staff and I have talked about it. We think it makes a lot of sense. I obviously want to explore it a little bit further, but as an initial reaction, I think something like that does make sense. We're not looking to catch people with foot faults, and so insignificant deviations from the requirements of the exemption shouldn't blow the exemption up, from my view, and it has worked in other contexts. So we would absolutely be looking at that.
Great. That is a great answer. Now, in terms of the structure of the bill, we have smaller issuances, and we have a graduated scale up to $1 million. The idea being that smaller issuances under $100,000 are a little different than issuances of $900,000. Do you foresee, and would you support the rulemaking that in essence categorizes issuances based on their size?
I think it's a very good question, and it's something that we have not made any decisions about. At a minimum, it's something we could ask questions about in a proposing release about whether we should create some kind of scale for different size issuances. And as you know, we have a lot of comfort with scale disclosure at the SEC in other contexts. Title I, the IPO on-ramp, has a number of scale disclosure provisions in it that we think are very manageable from our perspective. So it's something we would definitely be looking at.
Excellent. Do you need some? You do have water. Okay. And with that, I'll now recognize Mr. Quigley for 14 and a half minutes.
Actually, I just have one area of interest, Madam Chairman. The other day we talked about leapfrogging and the pressures the SEC faces to deal with these two major bills, Dodd-Frank and the Jobs Act, and that there was a concern that there was pressure on you to leap ahead and get to the rules completed that aren't due yet when there are rules dealing with Dodd-Frank that haven't been completed in past deadlines. I mean, do you feel this pressure, and how do you address the political realities out there of getting all these done on a timely basis?
Well, we absolutely feel the pressure, and I wish we could be moving more quickly to get all of these rules completed at the agency. But we've tried to prioritize based on deadlines for Dodd-Frank. We've either proposed or adopted 3/4 of the more than 90 rules that we're required to do. We've done 14 of the 20 or so studies. And this summer I expect we'll complete several more of the rules. The biggest piece that's left are the over-the-counter derivatives rules, which we would hope to substantially.
That's on Dodd-Frank.
That is Dodd-Frank.
And the biggest part left on Jobs Act?
Jobs Act, I would say probably the general solicitation rule, Reg A, and the crowdfunding exemption. So there are pieces of all of those. We will endeavor to meet the end-of-the-year deadline for crowdfunding. General solicitation had a 90-day deadline, and Regulation A doesn't actually have a deadline, but it is a very significant rulemaking. So we do the best we can with our staff in balancing. Many of the Jobs Act requirements fall to the Corporation Finance Division. They also have responsibility for the asset-backed securities rulemaking that's going on under Dodd-Frank, as well as conflict minerals in the Congo, extractive industries disclosure rules, and all the compensation disclosure rules, including pay ratio. So there's a huge burden in that one division, and they're doing a phenomenal job, and they're pushing things through, but we just keep our noses to the grindstone and try to turn things out as best we can, roughly prioritizing based on the statutory deadlines.
Well, good luck with all that, as they say, and I thank you for your service.
I thank my colleague, and I've got a few questions on cost-benefit analysis, and I must start by saying that I appreciate your prompt action on cost-benefit analysis. And the draft guidance that you have put forward and you've made public, that you testify that the Commission staff is abiding by currently, is a welcome sign. And I think that is a good government initiative and showed strong leadership on your part to make that happen. And I do appreciate it. And like I said at the very beginning, you've had a distinguished career in public service that is a rarity in this day, to have a career in public service and maintain your reputation at the same time. And so with this cost-benefit analysis, I just have some questions on that. And we do appreciate when we have document requests that you and your staff comply to the best of your capacity to do that, and that is helpful. That doesn't make headlines, but we certainly appreciate it. And you do have a very fine staff, and we're very grateful in my interaction with the Commission staff and the Commissioners, for that matter, that we have integrity in this body, and that is very important, not just for our oversight role, but for the public. I mean, to have confidence in the markets, and that is obviously a challenge with some of the things that we've seen in the past with market failures and fraud that occurs in our public markets. Just like fraud occurs and law breaking happens in society. So we in our letter to you on May 23rd, we ask whether job creation specifically will be considered in economic analysis. And in your response from June 11th, you said, in performing the foregoing analyses with respect to particular rulemaking, the Commission may need to consider the impact of the rule on job creation, economic growth, and competitiveness of the U.S. exchanges and issuances. So I want to understand the word may. Now, I'm not a lawyer, and so the difference between may and shall is very significant. I want to understand why it's may consider job creation.
Sure. I think we don't really look at our economic analysis as going specifically to that one factor, but we must consider burdens on competition of our rules, and we must consider whether our rules will promote efficiency, competition, and capital formation. And if you equate capital formation potentially to job creation, it will certainly be covered in that. So I think it's that we don't separately pull out a line and says this will create X number of jobs or this will hurt X number of jobs. But we would talk about if our rule might cause people to reorganize their businesses in such a way that they avoid our rule and therefore move overseas. That would obviously have an impact on jobs in the United States. So it's a broader inquiry that we must do, but we don't single out job creation necessarily as a specific factor. And so I think that's the reason for the use of the word may.
Is there a distinction between must and shall? And I'm not trying to do this as trivia, just in
not to me.
Okay.
I think generally things are written as shall in rules and legislation. But I take it as a directive.
Okay. So, when we're talking about economic growth, most people think about economic growth in terms of job creation, and that to me is a question. You outline as well. The Commission's hiring 16 economists and asked for funding to hire additional 20 more in 2013. And it's also interesting because we asked this as well. In contrast, in fiscal year 2012, the Commission hired 67 new attorneys. 14 more have specific start dates within the next few months, and additional 24 candidates have been offered positions or are pending background checks, and another 65 positions are under active recruitment. So that's total hiring of 170 folks. This is a 10-to-1, more than 10-to-1 ratio of attorneys, lawyers versus economists. So, given that recognition that economic analysis must be done, there's still this great prioritization of hiring attorneys.
I'm happy to address that. And I should add, we have, in addition to the 16 PhDs who are joining us this summer, we already have 23 economists working on economic analysis just in our Division of Risk Strategy and Financial Innovation. We have other economists who do risk modeling and quantitative analysis. But you're right, we hire more lawyers than we do economists, although this is, I think, the largest ramp-up in economists in the agency's history. Because we are, everyone needs to remember, a law enforcement agency as well. And we bring in the neighborhood of more than 700 enforcement cases every year to try to remedy violations of the federal securities laws. And the other thing that's important is that we have a lot of accountants who also both support the enforcement initiatives but also oversee FASB and the accounting standard setting. The lawyers we are hiring come to us with very specific experience. It's really critical to the agency's ability to carry out its mission. So we've been hiring people from hedge funds and private equity funds, with expertise in broker-dealer risk and operations, structured finance expertise, trading backgrounds, expertise in exchange-traded funds and derivatives. So we have lawyers who are responsible for much of the market structure, the investment company regulation, and the corporate finance disclosure review regulation. And we need them to do our jobs, and we need them, obviously, very much to do the enforcement work.
I certainly understand that. And as I mentioned, the current guidance on economic analysis is on your website. And you making that public is appreciated, and this in commendable as well. In our panel that we had 4 panelists earlier this week. They all lauded this, and it's rare that you can get 4 individuals testifying before this subcommittee and agree on anything. So that is a very positive thing. So, and this is binding on staff now.
Yes, it is.
Okay. Now, and is this the final rule?
It is the operative document right now. The staff is following this guidance as it's published on the website. We have asked the commissioners if they have comments and additions or changes that they would like to see, and we're working through that process to see if there are views that the Commission would like to have expressed, in which case it could become a Commission document. The Commission could actually vote on it. But right now, this is the operative way forward for the staff and the rural writing divisions.
Will you make those comments public?
If any changes we make to the document, we would certainly we would make public.
And would you explain why those changes were made? Would you commit to doing that as well?
If it's permissible to do that, if there's not some rule that prohibits it.
Okay. Some law or rule? Okay.
Yeah, deliberative process or something.
Yeah, I'm very interested because if it's applicable now to the staff and binding on the staff now, then any changes could endanger the analysis that's already out there and impact. And so we'd have pre-memo and then have this sort of interregnum here that we're currently in apparently. And so the concern there is that with any changes,
we explain why they're.
Yes,
that seems fair to me, and so as I say, I have no objection, not having been told yet by the General Counsel's office that there's a reason we can't do that. But I just want to add, I think this guidance.
They're proximate, so I'm sure that I could just look at faces and determine.
This guidance, I'm enormously proud of it, and I'm enormously proud of the staff work that went into it, because frankly, I think it informs good policy making, and that's what we need to be about. And it really forces us to go through the kind of process you would hope that policymakers would engage in before they pass rules that can have a very profound effect on many people.
You released You released a memo to us and with one of our document requests. And it's a memo dated, if we could put it up on the slide, it's a draft of October 31st of last year. And you released this, it looks like a completed draft. And if we go to the next page. So this deals with President Obama's executive order that outlines that independent agencies are supposed to develop a plan for a retrospective of existing regulations. And this was a directive, well, more of a presidential request of sort to independent agencies, saying that you should be doing this and looking back at rules. I don't mean this as a gotcha. This is certainly, we can provide you with the memo. But what was interesting is that it says, it outlines in a timely fashion from the President's instruction to independent agencies from July of last year. This draft was from October 31st, and it outlines the elements of the plan. If we'll go to the next page here. So we're publishing the plan on the Commission's website. Has that been done?
Excuse me. No, Mr. Chairman. That requires the Commission to approve the plan, and the Commission has not yet voted to approve the plan.
Has it been brought up at a Commission meeting, or is it still?
It has not been brought up at a meeting. It was provided to the Commissioners, I believe, October 31st of 2011 for their comment, their input, their changes, their views, and that process has gone very slowly, and we don't have all of their views incorporated into it. But I should hasten to add that that does not mean we are not doing many of the things that are already in the plan, because the plan incorporated a number of current processes that have been ongoing at the Commission for years, like the 10-year Regulatory Flexibility Act analysis and responses to requests for relief and guidance, or rulemaking petitions that ask us to revisit rules. Our advisory committees raise rules with us that give them concerns. We have roundtables where rules are raised for us to review. We obviously have lots and lots of meetings with industry and they're not shy about telling us about rules that they think we need to look at. So a lot of these processes are going on, but you're right, we have not published the retrospective rule review because the Commission has not yet voted to do so. I'm perfectly comfortable with it as it is and would vote to go forward.
Will this be on the agenda for
I think if we can't break it loose, we'll need to put it on a public meeting agenda at some point, yes.
Well, it was interesting because, and I do appreciate this, and I mean this sincerely, that you've released this, and, we requested documents dealing with this, and you freely submitted it to us. And I think it's a reasonable draft, and it was done in a timely fashion to when the President requested it. And to me, when part of it says we'll put this on the website, we'll make this public, including, and I want to put this on the slide because the fact you support it, this is an important slide. One more after this. We will take several steps to enhance public understanding of our retrospective review processes and to engage in more active public outreach seeking input for our identification of rules for review and our conduct of such reviews, including, and you go through a number of things, public outreach and on and on and on. So it's a good memo, and I think the fact that the staff came forward, that you support it, is a very positive thing, and I think it would be helpful to the market to see this process that you've outlined and done it in accordance with the President's executive order.
Well, I agree with that, Mr. Chairman. In fact, I would point out that in developing this document, we went out to the public twice, in March of 2011, where we asked for public input on reviewing existing rules, especially rules that impacted smaller businesses. And then again in September, we invited public comment specifically on how we should develop this plan. So it was done with some care and some thought. So I will endeavor to see if I can get it broken loose.
Thank you. I appreciate that. And as I said, I know you're one of 5 commissioners, but the chairman has significant sway.
I hope that's true.
So dealing with cost-benefit analysis. So the SEC is going forward. We can take the slides down. The SEC has put forward this memo. It's binding on the staff to actually look at the costs and the benefits of rulemaking. It's done in a way that I think economists would say is appropriate and rigorous. The procedures going forward for a review process are significantly different than the previous commission's process for economic analysis, which has been viewed as more or less perfunctory rather than essential, an essential checkoff in order for a rule to go forward. You can tell the memo, I think, is good in my opinion. But there are also self-regulatory agencies, and these SROs, FINRA, PCAOB, the Municipal Securities Rulemaking Board. These SROs rules are subject to Commission approval, and as such, I believe that they should be subject to the same economic analysis that the current guidance demands. Do you think that SROs should do cost-benefit analysis in their rules?
It's a very good question. There are 32 self-regulatory organizations, and they file something around 2,000 rules with us every year. So just the volume is quite extraordinary. And I think many of the rules, 77% of the rules, in fact, go effective immediately upon filing with the SEC. Of those that are left, a number have to do with new products, new business lines of business, particularly for exchanges, and in Dodd-Frank, Congress very much streamlined the process for those remaining rules in a way that would actually bolster those businesses' ability to get to market faster, encourage innovation and speed. So engaging in a full-blown cost-benefit analysis for each of those rules could defeat the purposes that were just put in place of making us go very quickly to approve those rules in order to allow them to get to market quickly.
Now, it's a small number that are non-ministerial and non-procedural in nature. Would you say that major and significant rulemaking?
Well, I think there's probably a way to talk about it where it does make sense. I think there are probably some category of rules where more analysis ought to be done. They do an analysis of burdens on competition in SRO rules, and we at the SEC, in approving those rules, are in fact required to do the what we call the ECCF analysis, efficiency, competition, and capital formation analysis when we're looking at SRO rules. So there is that which is already done, but there's probably a small subset of SRO rules where further analysis we should be talking about that. I don't disagree with that. I do think it would be a mistake to have a blanket requirement across all SRO rules because the analysis can take a very long time, and again, many of them are more routine and operational. And probably don't call for that kind of an effort. I would just also add, as you know, under the Jobs Act, the PCAOB rules that would apply to emerging growth companies have to be determined by the SEC to be necessary in the public interest and promote efficiency, competition, and capital formation. So there's that addition.
And to that point, the question of public interest, the SEC. Look, I'm in your wheelhouse right now. I'm talking about an SRO, and I'm talking about the SEC. And I know you've got great expertise with your prior experience, your previous job with FINRA, of course, and so you've got great experience with this. So there's certainly rulemaking from the SROs that should take into account the economic, the draft guidance you have put forward for the economic analysis. Now, how can the SEC rule and determine whether or not something's in the public interest? I mean, so let's just set aside the ministerial part. Let's set aside sort of paperwork provisions and some basic procedures that so many of these rules by their nature, the SROs can react faster than a government regulatory body in adapting those wide variety of rules, right? So how can you determine if it's in the public interest if there hasn't been an economic analysis done on significant rules?
Well, the SROs are required to discuss the reason for the rule, the justification of the rule, what benefits they believe the rule will bring to different constituencies. They are required to discuss the potential impact of the rule change on competition. When we put the rules out for, this is a very important part of the process, is when we put the rules out for comment, and commenters give their views on the burdens on competition or the necessity for the rule. We then work with the SRO staffs to make sure they respond to those comments in any final rule approach. So there is, I don't want to leave the impression there's nothing there for SRO rules. There is. I think the question is on whether on rules that have a more major, profound impact, we should be seeking more economic analysis, I think is a fair question for us to look at.
So if we can go to the slide on the dissent from SRO rulemaking, and it reads, any rulemaking, whether by self-regulatory organizations such as the MSRB, which is a Municipal Securities Rulemaking Board, or by the Commission itself, should be the product of a careful and balanced assessment of the potential consequences that could arise. The decision-making process that led to the Commission's approval of the MRSB's proposed rule changes falls short of meeting the benchmark. The Commission has a fundamental oversight role with respect to SROs, and undue deference to an SRO in the SRO rulemaking process undercuts the basic structure of that regulatory relationship. Now, I understand this is a dissent. The majority were, 3 commissioners, and you being one of them, were on the other side of this. And if you could respond to that, I would appreciate it.
Sure. I think what I would say is that the majority of the Commission believed the rule did adequately address the commenters' concerns and did an adequate analysis for us to conclude that the rule was appropriate. I will also say, though, that this rule was about to become effective by operation of the calendar because at the outside we only have 240 days to approve or disapprove a rule, and then it goes into effect. So that said, I think, look, we will always be willing to try to improve the analysis of SRO rules and rule filings, and obviously, we have all read the dissent, don't agree with it, but we've all read it, and we will strive to do more.
Okay, thank you. And I did want to give you the opportunity to comment on that. So I've just got a couple other provisions within the Jobs Act that I just want to get your feedback on. Will you exempt Reg A from the shareholder cap under 12G of the Exchange Act? Do you foresee that? Sure.
So I understand from the expert that we will consider it, but there was not an explicit exemption provided in the statute, but it's something we will consider.
Well, do you believe that the SEC has that authority to provide for that exemption?
Yes.
Okay.
I am told.
Okay. And I'm not, again, I'm not trying to play gotcha. And if I go back to SRO, or if I go back to questions about SROs, you could play gotcha with us.
I wouldn't do that. But and obviously, if we can always supplement the record, I assume on that
Absolutely.
point. But the Reg A rulemaking, which is going to be a significant one, is one that does not have a time limit. So we've prioritized general solicitation and crowdfunding.
Excellent. Very good. Okay, so to accredited investors. Accreditation is obviously unnecessary in the case of transactions among family members. And so will the Commission create an exemption to the accreditation requirement if it applies to the 1,500 additional investors in cases where the shares are transferred or sold to children or grandchildren, family members, in cases where shares are received as gifts or inheritance?
I don't think we've made any decision about that. It's certainly something we will look at.
If you could comment for the record on that.
Sure.
Thank you. And the increase to the registration threshold for banks from 500 to 2,000 shareholders. It failed to include S&L institutions. So will the Commission correct this apparent oversight?
Well, this is an issue. I've spoken with a number of members of Congress about it. Our staff has met with the Community Bankers Association, and we're in the process right now of trying to understand the similarities and differences, frankly, between thrift and bank holding companies, so that we can understand, for example, what types of reports thrifts file as banks do with their regulators, whether shareholders have access to them. We're also talking with the OCC about that. And so it's an issue that's still open. I understand the deep interest in it. I will say that we've done the research to say that we believe there are about 114 thrift and S&L holding companies that are registered right now under the Exchange Act. And of those, about 86 have fewer than 1,200 shareholders of record and could delist. So given that large a universe, I would think we probably need to approach this through rulemaking rather than through one-off exemptive process or something. But it's very much on our radar right now.
Okay. Thank you. I appreciate that, and I appreciate your willingness to comment on that. And then I would be remiss if I didn't ask about money market funds. And I know you've made enormous comments on this, but we're talking about a $2.5 trillion industry, and so there is strong opposition from the industry, as well as some state and municipal treasurers as well, and what that would do to liquidity, especially in this time where we're looking to what is happening in Europe and the implications that obviously has on world markets and liquidity in the world market. So I would give you the opportunity to comment, please.
I'd be happy to, and as you rightly point out, I can talk for a very long time on this subject because I feel very strongly about it. The American taxpayer was on the hook when the reserve fund broke the buck in the form of a guarantee of money market funds, which at that time were over a $3 trillion industry in the United States. And my view is the American taxpayer should never be put in that position again. One way to ensure that is to try to deal with the structural weaknesses that exist in money market funds in a way that allows their value to actually float to reflect the value of the underlying securities, just like any other mutual fund. So this event of breaking the buck is not a monumental event that causes people to run for the doors. And that is the second weakness, is that as the value of a money market fund moves towards 99 cents away from the true $1 value, there's a huge incentive to get your money out at $1 and leave the losses concentrated in those slower moving small business and retail investors who are left in the money market fund. And the potential to create a panic is extraordinary. And in 2008, when Reserve broke the buck, within a matter of a couple of days, $300 billion was pulled out of money market funds. And it was really only stopped because the Treasury and the Fed stepped in with a guarantee program and a liquidity facility. And I think before we have another crisis, I hope we never do, but in the event we do, I think it would it'd be wise for us to have taken the steps to bolster the resiliency of money market funds to withstand or to prevent runs. They are very valuable tools. They are used by retail investors, by businesses, by state and local governments, as you point out. We think they can be made stronger and better by either having a small capital buffer to absorb those small variations in price or to have their value actually float.
So there is, the Commission has a 337-page proposal. As we read, I believe it was yesterday in Bloomberg, I believe. So this staff proposal, did it go through the economic analysis?
This is a proposal to the Commission, so nothing's been made public or published, but it contains an extensive economic analysis, yes. Okay,
it does. And there are, it's a either or, either, float the NAV or hold more capital and curb redemptions. Those
would be choices that funds could choose between.
Okay. And from what we've heard and read, there's not a unity of thought on the Commission quite yet.
Not quite yet, and I'm ever the optimist. And now that they have a document to look at, and obviously it's going to take a little time to read it and absorb it and have conversations with the staff about it, we'll see where we go from there. But I'm optimistic that people will think that this is something that needs to be publicly aired and discussed and debated.
Okay, thank you. Chairman Quigley, if you have any final comments or any final time you'd like.
Thank again for your service, and appreciate your coming back again and again.
Thank you. And two final things of note. Would you be willing to come back in September and give us an update? We'll be happy to work with your schedule, and we know you obviously keep a very hectic and busy schedule, and we do appreciate your willingness to submit to congressional oversight.
Of course, I'm more than happy to come back.
Thank you. I appreciate it. And again, I've said this a number of times, but I do appreciate your public service, and I do appreciate your willingness to be open and transparent and engage in this conversation, this discussion. And to that end, I'd love to give you any opportunity to address anything that I've not raised, or any comments or any corrections or additions you'd like to make.
Although that would be hard to imagine.
I can't think of anything. Thank you.
Thank you. And look, I deeply care about this and the work that the SEC does, and I want to make sure it's done correctly, and the American people know what's happening in this process, and so there is some certainty in the marketplace about the process, the procedures of the SEC. And the final comment I would make to the ability to raise capital in this country is that entrepreneurs are waiting for these opportunities that will come out of the rulemaking that you're undertaking. And your work is important, and it has an enormous impact on large and small businesses and economic growth, and entrepreneurs are waiting. And we are certainly interested in the work you're doing, and certainly appreciate your willingness to work with the public and work with interested parties, get their feedback, and make sure that these rules are done well. And so thank you for your testimony. Thank you for being here today. And this hearing is now adjourned.